The Reserve Bank of India's Monetary Policy Committee has kept the repo rate unchanged at 6.5% for the sixth consecutive time on February 8th. RBI Governor Shaktikant Das said that the decision was taken by a majority of 5-1. The repo rate was last changed in February 2023 when it was raised from 6.25% to 6.5%. Between May 2022 and February 2023, the repo rate was hiked by 250 basis points. Governor Das said that the impact of the 250 basis point hike in the repo rate was yet to fully unfold. Earlier this week, the Business Standard poll had predicted that the repo rate would be kept unchanged. The RBI MPC also decided to keep its stance of withdrawal of accommodation unchanged with a majority of 5-1. While the latest MPC meet maintained the status quo, it wasn't without any important messages. On inflation, Governor Das retained the forecast for FY24 at 5.4%. However, the inflation projection for the current quarter was lowered to 5% from 5.2% earlier. The inflation projection for FY25 was kept unchanged at 4.5%. However, the projection for Q1 FY25 was lowered to 5% from 5.2%. The projection for Q2 was retained at 4%. Meanwhile, Q3's was lowered to 4.6% from 4.7% and Q4's was pegged at 4.7%. The RBI MPC's decision comes at a time when the inflation rate in India has been below 6% for 4 months since September 2023. However, it has not yet reached the target of 4%. Moreover, retail inflation rose to a 4-month high of 5.69% in December 2023. The jump in inflation was due to a rise in food prices. In his first monetary policy statement of 2024, Governor Das said that the softening in core inflation continued across both goods and services. Core inflation moderated to a 4-year low of 3.8% in December. While highlighting that headline inflation has seen a significant moderation from the highs of the summer of 2022, Das cautioned that recurring food prices shock could interrupt the ongoing disinflation process, with risk that it could lead to de-anchoring of inflation expectations and generalization of price pressures. According to Das, adverse weather events remain the primary risk with implications for the Rabi crop. Pointing out that the CPI inflation target of 4% was yet to be reached, Das said that monetary policy must ensure that the last mile of disinflation is successfully navigated.
Inflation, there are a couple of points made by the RBI. One is that the headline inflation number will definitely ease and come down to 4.5% for fiscal 25 compared to 5.4% for 24. This said, however, the RBI is very cautious of the fact that inflation, which has been driven primarily by food products, is something which has to be monitored carefully, because even though core inflation is under control, the sense which the RBI gets is that in case food inflation goes up for any particular reason on the supply side, it could also have a disruptive effect on core inflation because inflationary expectations start getting moderated or rather generated. And this is something which could upset the apple cart. Otherwise, the RBI is definitely looking at a lower inflation number for fiscal 25.
On India's economy, Governor Das said that the GDP was projected to grow at 7.3% in FY24. For FY25, the GDP growth forecast has been kept at 7%, with Q1 at 7.2%, Q2 at 6.8%, Q3 at 7%, and Q4 at 6.9%. Governor Das highlighted that going by the first advanced estimates, FY24 would mark the third successive year of growth above 7%. He said that going forward, the momentum of economic activity witnessed in FY24 was expected to continue in FY25. The governor cited various positive indicators. Agriculture activity was holding up well despite lower rainfall, lower reservoir levels, and delayed sowing. Rabi sowing had surpassed last year's level as well as the normal acreage. Meanwhile, industrial activity was gaining steam on the back of improving the performance of manufacturing. Services sector activity was expected to remain resilient on the back of strong domestic demand and stable global prospects.
I think the economy is quite robust. At 7% GDP growth, over 7.3%, I think it's a very strong rate of growth. And I think he gave data to support that, whether it is the PMIs, or it is for both manufacturing and services, or it is the other factors like tax collections, etc. I think they have all been pointing towards a strong growth last year, and that seems to be likely to continue in the next fiscal as well. IMF has also kept its GDP growth for the world economy at 3.1% now, which is the same as last year. So clearly, I think they are also seeing growth steady.
On the demand side, the governor said that the improving employment conditions, moderating inflation, and a rebound in agriculture activity should push up household consumption. He also said that rural demand continued to gather pace with strengthening farm-level activity and the extension of the Pradhan Mantri Garib Kalyan Ann Yojana likely to further support rural consumption. Meanwhile, urban consumption remained strong on the back of improved income levels.
Private consumption is something which the RBI is again fairly sanguine about because it expects consumption to continue to pick up next year. In the current year, it has given evidence looking at various indicators that there has been kind of a pickup in consumption. And given the fact that we are looking at GDP growth being maintained at a 7% range next year, it would also tantamount to consumption increasing at a fairly rapid pace.
Apart from these crucial messages on growth, inflation, and consumption, our experts had their own take on what stood out the most during yesterday's MPC.
See, actually, what really stands out is the reiteration that the stance is one of withdrawal of accommodation, which is based on the fact that the full transmission of the 250 basis points hike in the repo rate over the last couple of years has not yet been fully accomplished. So this, along with the fact that it says that while inflation is something which they expect to come down, but their target is still 4%. So they need to be convinced about the fact that even though inflation is coming down, that it is coming down in a durable manner. So therefore, one can actually get a clue that not before the second quarter of next financial year can we expect any action on the repo rate.
The other message relates to the budget and monetary policy connect. The budget was non-inflationary because it has reduced the fiscal impulse by cutting down the deficit to GDP ratio. So the coordination between monetary and fiscal policy is quite good, and both are aiming to control inflation. And whenever the opportunity for RBI to cut rates come, fiscal policy will not come in the way of that.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
He's making plans for an early retirement. Business Standard.